Hello, everyone, and welcome to a very special episode of the Property Trio, although not so special because we're missing one of the band members. Dave Johnson, unfortunately, is an apology for today. But luckily, I've still got Cate, and
Yeah.
you can do the whole thing by yourself, really. We're just kind of the supporting act. How
Oh,
you
good
going?
on you. We've got this. I'm good. It's lovely to see you. Had a really good time with you at the Pippa conference. That was a lot of fun.
Yeah, and I suppose we unpacked a lot of different things that segue nicely into the topic that we're going to talk about today, and that's the unintended consequences of government intervention. And I don't know if I've lived through a time where I've been cognizant of as much government intervention in the property market especially from a state perspective. And sometimes you've got to ask the question, well, in some of these decisions, what are they actually trying to do? Because they might
Mm.
say something, but what actually happens is actually the opposite. And we want to unpack a couple of those things today. Where do you want to start?
Oh,
I'll let
where
you
do
take
we
control.
start?
Yeah, I
It's
know.
funny, isn't it? Whenever my phone rings at an odd hour with a journalist, it's usually about some piece of legislative change or a proposal or something that's been in the news that some crazy politician suggested. And there's always a lot of great material to talk about. But the interesting thing is the lack of consultation. And I don't want to sound like I'm on a political soapbox for this one. I think we've got quite a few diverse topics to move through and really correlate what was intended and what actually happened. It's fascinating. But if I can, I'll say that lack of consultation is probably a root cause of some of these negative outcomes. And it would be great if we could engineer a way for policymakers to be able to tap into a really good breadth of people and get all kinds of aspects and views, because when they do that, they might be able to determine what some of the risks on the other side could be.
Yeah, well, I mean, there's plenty of representation from the tenancy side of things. And I suppose if you look at the consultation, it's normally like a 95-5 tenants versus landlords sort of thing. But we are
Mm.
lucky to have Picker and Pippa in the mix who've been doing a lot of advocacy work. So the politicians have got access to that. They just need to seek it out and do
Mm.
and make use of it. One example that springs to mind that was kind of in your backyard, and we've talked about it a little bit, where the Victorian minimum standards legislation came through, and I know a number of property managers that have a big network of offices that really sort of said the consultation wasn't there and we had to make some drastic changes in a short period of time. And I suppose if you read it as a press release or just something on paper, it sounds wonderful, like minimum standards. A tenant should have the ability to rely on their property to be safe, to be secure, to be in functioning order, to be not,
Yeah.
a threat to them. But the reality was is that there were unintended consequences to that. Can you unpack some of those?
Yes, of course. And I'm with you. I want to say straight off the bat that having a safe, warm, reliable house, that's a right of a tenant. They've got a contractual arrangement with a landlord, and they need to have a property that's functional and safe. There were quite a few things that I guess were broad brushstrokes, and properties in various parts of Victoria are all quite different. You might have inner city properties, you could have coastal properties, could have properties in cooler climates, and to apply a one size fits all, really tough policy to try and support. But what the minimum standards legislation did for a lot of owners who were not necessarily cash flow rich, they might have had a lot of equity in the property but not much else. And we've got to keep this in perspective. When you're renting out a property in Victoria, the chances are it will be cash flow negative. It's very hard to find a cash flow positive property in Vic. So you're already dealing with high outgoings, and then you've had this occur at the same time as an increase in interest rates. And so all of a sudden the outgoings for an owner are significantly higher. And then they've got these enforced mandated changes that they have to roll out. For
Yeah.
some, it might trigger a really high expenses list. And if that is too high for that person to be able to manage, they'll be forced with the prospect of selling the property. And so, of course, we've seen a lot of sales for various reasons, a lot of investor-led sales, but the ones that have been investor-led due to financial concerns around bringing a property up to minimum standards, that's been really hard across the board, because we've also had a market that's been saturated with older style properties that need renovating. And we've got a disproportionate number of properties on the market that need renovating. And of course, that's also been an issue that's been amplified by the fact that we don't have a lot of builders out there, and building materials are expensive, builders are expensive, and they're hard to get. So it's definitely changed the marketplace. And if we have a think about the tenants that would have been renting those types of properties historically, it was usually, students and share house recipients, people on lower incomes that were really happy to have really cheap rent that was commensurate with the condition of the property. And again, I'm not suggesting that an unsafe property is okay, but a ratty or rugged property, there was always someone who was quite happy to take up that opportunity to rent that property because the rent was so cheap. So when you remove those types of properties, you're also removing that choice for people that were really happy with that kind of arrangement. So it's definitely distorted the market, and minimum standards were initiated, and all of a sudden we had a lot of items that we had to be mindful of. So the gas and electrical compliance testing is mandated, and that's every 2 years. That's a cost to the owner when they have a technician come along and do the testing. But for a lot of people that found that they needed to do more significant works, you're then dealing with gas and electricity reworks. That could be an entire rewiring of a house, which might be a $20,000 bill. So yeah, that's just a bit of an insight into how these changes affected the marketplace.
Yeah, and I suppose these things come from a good place, or at least you'd like to think so, but there are examples all the time where there's an unintended consequence. I remember speaking to a developer that bought this big block, and they had a very old house on the front that they were going to rent out while the development took place, and it wouldn't necessarily interfere with one another, but the cost to have that meet minimum standards was such that they actually decided to just have it sit there vacant. And yes, I mean, we want places to meet minimum standards, but there's always people that would be like, I don't care if one of the windows doesn't open, or like, I'm not going to use this part of the dwelling. I'm just wrapped to get into a property at this price point. And it does remove that ability, as you're saying.
I'm just thinking of one policy that I think is really crazy. One of the minimum standard points, and it's not related to risk or to health or to safety. It's actually in relation to a cooktop and where the ventilation or the fan needs to be located. And they've decided to specify that it can't be any closer than 60 centimetres above the gas burners. And if you think about old houses in the inner ring suburbs of Melbourne, where you have the old kitchen arrangement where the oven unit fits in under where the old stove used to be, and you often find that distance between the flames and where the fan will go might be 55 or 50 centimetres. Well, that's an immediate fail. Now, it was functional, it was working for everyone, and all of a sudden it's not good. And when you're thinking, okay, I can't use this cavity any longer for an oven, where else can it go in a kitchen? Well, if it's a tight kitchen, there is nowhere else for it to go. And that cavity is usually part of a chimney. And if you've ever taken down a chimney in an old house, it's a very laborious process, and it probably needs supporting beams or some kind of structural work done to rejig that kitchen. So all of a sudden you've got a landlord who has to do a full kitchen makeover in order to meet that requirement. That's just one small example, but it's a relevant one because it strikes for a lot of people.
Yeah, and I suppose government intervention is not just exclusive to the property market. I mean, one example we saw the environmental minister, Peter Garrett, back in the day with the pink bats thing. And that was great, like we can get all this sort of subsidised installation in the roof, but it generated a cottage industry, and there was quite a few cowboys that entered that. And unfortunately, we saw a fatality, or at least one that I know of, due to not necessarily having those safe work method things in place. It's a fairly broadly implicated thing. I don't want to focus purely on Victoria, but I mean, you guys
and
sort
nor
of
does
do
it need
have
to be rentals versus, renters versus landlords. I think
Mm,
there's so many policies and intervention pieces, initiatives, and grants that we could talk about. They're not all
mm.
related to the rental market. But yes, Victoria, we've definitely, led the chase on all of this. And you talk about cottage industries. It's a horrific topic if you delve into it and you see some of the badly behaved tradespeople that are taking advantage of some of these policies.
Mm. And a policy that Victoria had in common with Queensland, however, it was repealed in Queensland and continues to this day in Victoria, is the land tax changes. And we crunched some numbers on that just to try and support the lobbying effort that was done by Pippa and the REIQ and presumably the REIV as well. But that Queensland land tax legislation was, well, I mean, it was legislated. Let's talk about that. It was ultimately repealed, but we actually worked out that if you allow for settlement periods and exchanges and all those sorts of things, we calculated that there was a 98-day period between the implementation of this and repealing. So, i.e., 98 days where people could transact knowing that this legislation was about to hit them in 1 July, and we actually saw a 17.8% drop in investors buying in Queensland in favour of other states because of that. I mean, that's an incredible knee-jerk reaction. I mean, that's the perfect proof of of the unintended consequences, and I think
Yes.
Newton's third law of motion in place there. And we can contrast that to the data that we collected in Victoria. Now, Victoria was a fairly unpopular state. It attracted only 9.4% of all property purchases compared to other states in the 2 years prior to your land tax announcement. But within the 6 weeks after the announcement, it went from 9.4% of investors buying in Victoria in our data to 5.7%. So two very different states, two examples of similar policies, and two bits of, I think, fundamental truth that shows that people voted with their feet and they thought, I don't want to be an investor in these states because of these policies.
Yeah, without a doubt, the data absolutely tells you the answer to that. And nobody could doubt that. I think that your contribution at that time with real data was groundbreaking and very, very exciting for a lot of us as well, because anecdotally, we're all pointing to that. But once the data came out, you really couldn't refute it.
Mm. Yeah, I think anyone that has access to that sort of stuff has an obligation to try and share that where they can. And we were only a very small part of the big sea of voices that helped to repeal the Queensland one. But you got to do your bit, haven't you?
You
Uh,
do. And collectively, we've got some great data. I mean, your data is so special because no one else collates it. You've
mm,
got a viewpoint that nobody else would have, and so you can really track this investor behaviour through your quantity surveying work. I also love the fact that CoreLogic and PropTrack could identify investor-led sales. I think
mm.
that was really valuable because, again, anecdotally, we're all talking about it. Policymakers were saying, "Oh, it's not an issue, and we're doing the right thing, and more homeowners are purchasing property." But we can really track who purchases a property and who sells it, and it's absolutely distorted our Victorian sales figures. There's no doubt.
Yeah, that was great. I mean, because we had the one side, like there's less people buying, and PropTrack, for example, had the, well, there's more people selling. You add
Mm.
those two things together, it decreases the rental supply. And I think we've seen that in vacancy rates in those states and across the country, really. Let's move away from the land tax stuff because I think we've done that to death in
Yeah.
previous episodes
I
as
want to
well.
talk about buyer stuff. I mean, we've talked a
Yes.
lot about people bailing out of the market. Let's talk about the initiatives and incentives and grants and government intervention that encourages people to buy into the market.
Yeah, well, let's go with first home buyer stamp duty concessions because that's a perennial one. Where
Mm.
as a country, we've definitely put a lot of effort into helping new people to join the property market, the first home buyers. But these incentives, they're stimulatory and they can have negative consequences if you're one of the people that misses out on a particular grant. But what's your
Mm.
read on the implications for these stamp duty concessions?
I like stamp duty concessions. I think they're great for first home buyers. Sometimes I think we could really open up the floodgates to more eligible people. And in different states and territories, there are opportunities for concessions based on, healthcare card recipients and pensioners, that kind of thing. But we also have to keep an eye on the thresholds because they can quickly fade out of date and not be so useful. And what I mean by that is if the concessional cap on a purchase price isn't making sense for someone who, for example, a young family, if there's a concessional cap that eliminates most of the properties that would be appropriate for those buyers, then it's a silly policy. And we know that we've seen Sydney, for example, introduce much higher caps than anywhere else nationally, and that makes sense because their house prices are so much higher. But when we first introduced concessions in Victoria, I remember when this started, and like anything that you introduce, you get an opportunity to finesse it, make it a little bit better as the years go by because you realise the shortfalls in the initial policy or an initiative, and it's good to see when governments will change that up and make it a better policy. It was a hard cut-off, and so anything above 600,000, there was just zero concession, so very black and white. We've now got shades of grey, which is great, and they've got a sliding scale. So between 600 and 750, the stamp duty concession starts to nudge down, and when you get to 750,000, there's no concession. So that's been a better policy because we were distorting the market. It was really split into two camps. It was anything above 600,000 and everything below. And what we did see at that time was first home buyers came out in force and they wanted to get this grant or this concession, and they were happy to spend right up to the $600,000 mark. And anything above that, they'd miss out. So, of course, we saw a lot of properties that might have been valued between 550 and 600 selling for 600. And you could always tell when an investor or a non-first home buyer was at an auction. You'd see a result of 601. In fact, I remember opening the bidding at an auction where I thought the property was worth circa six, early sixes. I opened the bidding at 601 because I could see a sea of first home buyers, and I just needed to make sure that that I could shake them off. And if I was working for a first home buyer, I could open the bidding at 600, get them the grant, and everyone else is chopped out. So really interesting way that this particular concession impacted the market when it wasn't finished. And now that we've got a sliding scale, for sure, you still see a lot of purchasing activity by first home buyers at that $600,000 to $700,000 mark, but it's not so black and white and not so visible that the concession has distorted the market like it did years ago.
That was a very interesting insight you just gave into the world of being a BA. And I mean, my mind went to, okay, well, there's a 600 cap. Well, you got to start, in the high fives and then work your way up and stay under. But if you're on 600 and there's any other first home buyers, well, they actually got nowhere to go. It reminds me of the old Price is Right. You have to guess, what the price of the asset is. And then, someone will guess. And then, the real clever people will go that one plus $1. The people that make that gap, it's like, well, you're just giving up. You're giving up leverage. But yeah, that's just my inner nerd that's got a tickle out of that.
Well, I used to often say to my first home buyers when I was bidding back in those days, if the bidding gets up towards the 580 mark, and especially if we know that the property is worth 600, if we've got that confidence, we'll have to do a slam bid because you don't want someone else to beat you to it.
Yeah. Oh, yeah, exactly. Because if someone does it, then you'll be like, oh, yeah, 600 and like I brought, I don't know, a newspaper and a coffee. You can have that.
Yeah, exactly. No, once you go to 601, you don't get that concession. So the entire outlook and the cost of it is significantly different. We had a COVID stamp duty incentive that the Victorian government introduced back in 2020 and 2021, and it was up to $1 million, and it was half price stamp duty for anyone. So investor, second home buyer, whatever the person, if they were under $1 million, they got a 50% discount on the stamp duty. Well, of course, we saw the same sort of thing. That was a silly policy as well because it was a hard cut-off. And so we saw this flurry of buying activity where anything that was worth $950 or above was selling for $1 million. Just
And I
crazy.
remember calling you up and saying, I'm looking at the data and Melbourne's tanking. What's going on? And you were straight away able to say, well, this is the problem with median house prices. And
Yeah.
the best way that I've found to explain it is in price segmentation. And the easiest example is, let's say, a coastal market that has the waterfronts that are worth $5 million. And then 2 streets back, you've got things worth 800,000. If you get quite a few of those waterfronts transacting, then the median house price goes through the roof, and people are kind of thinking, oh, well, that particular market's booming, but it could actually be in decline. But what actually happened is we saw this, as you say, a flurry of purchases sub $1 million, and then the segmentation is pointing to these lower transactions which affect the median. And I think that's a real interesting kind of cautionary tale for the people that used to read those property investor magazines that says, this particular place is the best place in Australia to invest because it's just gone up 36% in the last 12 months. But you unpack it and there's not that many transactions, and the segmentation matters.
Yeah, absolutely. We had so much purchasing activity. The question was, did that stamp duty offering during COVID, which was a stimulatory measure, did that trigger more purchasing activity? Absolutely. So that was why your data suddenly suggested that Melbourne's median had moved. We just had a lot of first home buyer and upgrader activity in that time frame.
Something that does have a national focus, but I think Victorians have been gold medalists at, is underquoting. And there is now underquoting legislation. And, I worked in real estate for a short period of time. And when I heard about this, I thought I didn't understand it, because in my experience, let's say sales listing agents would always go to the vendor and say, oh, look, I think it's worth, 20% what the actual market value was. And they secure the listing and then bash them on the head through the campaign and go, oh, things have shifted, because it's all about the listing and then trying to manage the expectations. I mean, it's a nasty practice, but that's the practice that I saw as being, quite widely adopted. But coming in and underquoting, I couldn't quite understand. But explain to us what was the problem with underquoting, and what was the legislation that came in to tweak that, and what were the unintended consequences?
Yes. Underquoting's been an issue forever and a day, and especially in the auction-centric places. I mean, Melbourne, it's rife, unfortunately, and you always hear that Consumer Affairs are cracking down. They've got a task force. I have seen the task force, but it's a big problem and it's everywhere. And so calling out a few agencies and publishing situations where agents and agencies are fined, it may be a short-term deterrent. I'm not so convinced that it's working long-term. I think legislation has to change to change this issue. But for our listeners, just to go over this, we've done episodes on underquoting before, so they can certainly refer to those. We'll pop them in the show notes. Underquoting broadly is it's an old practice, and sometimes agents say quote it low and watch it go. That's the saying. I don't think it necessarily works every time. In fact, sometimes I've seen agents attract way too many buyers who have insufficient budgets, and all of a sudden, the vendor's realistic expectation isn't easily met because everyone there was attracted to the low quote. But I've seen all kinds of underquoting outcomes. Sometimes properties do fly. It gives the agent an opportunity to say to the vendor, I've had 50 groups through or 100 groups through or whatever the number is. Well, of course they have. They've, it's bait pricing, and lots of buyers will attend if they think there's a bargain to be had. Back in the day, when I first went into real estate as a real estate agent, back in 2003, we had underquoting changes rolled out back then. And at the time, the quote range had to be no greater than 10%. That was the rule. And so you couldn't do plus quotes. They used to do, 350 plus. I'm showing my age now. What can you get for 350 plus? And so all of a sudden plus quotes were gone, and you had to have a 10% maximum range. Then not too long ago, it was in the last 10 years, we introduced the statement of information. And the background there, the rationale for it, is Consumer Affairs decided that agents needed to justify their quoting and support. So demonstrate, show the justification. So on the statement of information, it states that 10% range, or a range up to 10%. And then you've got to list 3 recent comparable sales that support your pricing regime. So if you're in metro, they need to be no older than 6 months sales. And if you're in the regions, they can be up to 18 months. Already issues there. I mean, what do you do with Geelong? Geelong's market is very similar to Melbourne's market, especially when things are flying. So therein is one issue that we needed to shine a spotlight on. Anyway, the comparable sales needed to be, like the word suggests, comparable. So when I talk about comparable sales, similar land size, similar neighbourhood, can't be too far from the subject property, similar style of house, similar size, similar number of bedrooms, the list goes on, orientation, all of these things that you need to overlay and consider. Now, if you're asking an agent to list 3 comparable sales and the prices that they sold for, it's the onus is then on the buyers to check whether those properties are indeed comparable. And in a lot of cases, they're not. So let's say we've got a really cute Victorian terrace in a perfect street. It's got a great land size for a terrace. It might be 220 square metres. It's got a northerly rear. It's nicely renovated. And there's nothing negative about its location. So the streetscape is very pretty, and they've got a uniform array of other terraces. That to me sounds like an A-grade property. Now, if the statement of information is suggesting that property is quoted 1 million to 1.1, and I think it's really worth 1.3, the comparable sales on the back might be smaller land size. They could be properties that are in desperate need of renovation. They could be missing a bedroom, so 1 less bedrooms. They could be on significantly smaller land. They could be on a main road or a train line. The list goes on. So if an agent cherry picks an inferior property and puts it in the statement of information, who's policing that? Because all of a sudden we've gone from having a straight price quote where people can do their own analysis and have a look at what's sold. Now we're having to verify the 3 on the back of the statement of information. And the agent does have a box they can tick to state that they couldn't identify any comparable sales if they wish to do so. Obviously, if that file was audited and there was an abundance of properties that they should have used, they might get their knuckles rapped or they could cop a fine. But what I'm talking about is a convoluted way of demonstrating how a property's been priced now. So the onus is still very much on the buyer, and then they've got 3 other sales to try and navigate. They've got to work out what the land size was for those. Is it really comparable? Is it inferior? So I think that they've made it convoluted and messy, Mike. That's my point.
And a good point. And I think that, there's plenty of examples that we can talk about, and we've got a couple perhaps more to go through, but, often there is a disproportionate response to something, or there's certainly unintended consequences. And I suppose, it comes down to sort of a political discussion about the sort of society that we want to live in. I mean, if you look at the differences between Labor and Liberals, Liberal will talk about free market economics and not wanting to intervene too much. And we aren't exactly free. Like, for example, first time I went to the US and I saw people riding around on motorbikes without helmets, I thought it was absolutely mad. But I mean, us having to put a helmet on is an encroachment of our freedom, but one that we sort of agree is a good idea, because you have the right to endanger yourself, but the poor person who has to mop up the mess of you not having a helmet, we need to consider them as well. That is a very weird and esoteric segue into a little bit of intervention into the rental market. So in I think it was 17th of December 2022 in New South Wales, for example, agents have been prohibited from soliciting rent bidding. So, for example, if you have a place on the market for $800 a week to rent, you can't then accept offers of people saying, I'll give you $850 or some variation on that. Now, I suppose for the consumer, for the renter that's looking for a property, it unmuddies the waters, if you'll pardon that expression, because you should be able to put an application in and expect that you've got an opportunity to win that on merit, and people aren't coming around the corner and offering other things. But what we actually saw, and I don't have data on this, so it's an anecdotal thing, is that landlords were actually putting higher prices on these properties because they didn't have the opportunity to have someone swoop in and ask for more. So they thought, well, I may as well ask for a little bit more to start with. And then we see, an increase in rents. We see an increase in rental listings, days on market. So it's just kind of funny when we have these little interventions that are designed to sort of make things better, but it bubbles out around the sides. People find a way to circumvent them.
It is an interesting one because, rental bidding, it doesn't sound nice at all, but we're always quite relaxed about purchasing bidding. We don't mind sending people out to lock horns and go head to head at an auction in a public space. We don't have a problem with agents going backwards and forwards and getting the best result for their vendor. Yet we've got a problem with getting the best result for a landlord. It's a really interesting point, and probably one that the vast majority won't favour if we suggested that rental bidding should be reintroduced. And when you're talking about shelter and housing and people's right to have a home, I certainly understand that. But I always marvel at how differently we treat sales versus rentals.
Yeah, it's interesting, and it comes down to sort of like the political zeitgeist of the time as to where we're kind of parking these policies. And right now, with crisis levels of rental accommodation, it's likely to favour the people that are suffering the most, which I think is definitely a good thing in a lot of ways. But the politicians that are looking to be re-elected next year are going to be leaning into that. Now, we probably only have time for perhaps one more before we go to the gold nuggets, and we can talk about all sorts of things like windfall gains tax or home builder, all those sorts of things. I know. Well, I'm gonna force you to pick a favourite if that's the right word.
Well, let's talk about the home builder grant. That was meant to come from a good place. It was meant to be stimulatory, and look what happened.
Yeah, and I suppose the legacy of that we are sort of still dealing with to some degree. And yeah, on paper, we're hearing it now. We have a supply problem. It's all about supply. We need to build more. We've got the National Housing Accord. We've got the 1.2 million homes over 5 years where we're trying to build 240K a year. That's been happening since July was supposed to be the start point. We've got Buckley's chance of hitting that this year, and all the modelling is saying we might hit it in year 4 once, but there'll be a huge shortfall. But how did that sort of play out in your patch?
Look, we saw tradies pretty much disappear because, as we've talked about in many episodes, we've had all kinds of civil infrastructure projects and activity going around. But the home builder grant saw this sudden rush, and of course there was a deadline for that grant for people to use it. And so, as you see, whenever you've got a case where demand spikes, tradies could price it accordingly. So not only did we see a lot of them out of the market, we saw prices go through the roof. And of course, that initiated a change in pace when it came to buyers and their appetite for taking on a renovation property. And we then saw a marketplace where anything that was fully renovated was going like a hot cake and selling for a premium, and anything that needed work was either passing in or selling for a bargain. So it definitely skewed the market. But I think, again, like a lot of these grants and initiatives, it was about timing as well. The timing was terrible. And we've seen that impact continue, and we're still not out of the woods in relation to being able to get tradespeople and builders and building material and contemplate renovations like we used to pre-COVID.
The supply of trade labour at the moment is a bigger problem than materials prices. Obviously, we saw that 33% in material input prices during the pandemic, but we're now the lowest pace of growth for about 22 years for materials, as it turns out, but we can't feel it because of that rapid chunk of growth that we saw during that period. And I suppose if you think about labour supply, I'll give you probably two examples that have caused problems. One is intervention, one is natural. Natural being natural disasters. So when we have natural disasters like bushfires or floods or hurricanes, we get a huge pull of available trades to the rectification works, and the insurance companies have prepared to spend more money because they have to rehome people that comes at a cost. So the rates that tradies can attract are far more lucrative than building properties. So we can't really necessarily control that. I mean, we should recycle and not use fossil fuels, but it's difficult to change that yourself. The other thing is the huge pipeline of government infrastructure build that we've had in the last little while. Now, it's been sort of unwound to some degree because they understand the problems. But, when you hear stories about, people holding the lollipop signs for construction projects that the governments are doing, and they're on 180 grand a year when they can only get 110 in the home builder, it's the home building sector, it's pulling those people away. So that's probably another example of the unintended consequences. And for me, home builder, the grant was a huge kick in the backside from an inflationary point of view, and it's only a part of it, but it is a meaningful thing to consider when we're looking at this super sticky inflation that we're dealing with right now, right?
Yeah, absolutely.
Well, that's been quite a whirlwind look into some of the cause and effect and unintended consequences of some of the legislation. And he's hoping there's a lot less to talk about in the next 12 months on this side of the fence. But it's time now to go to our gold nuggets.
Now it's time for us to go mining for our gold nugget property tip of the day.
Okay, for my gold nugget, I want to talk about one more little point that we didn't discuss, and it was in relation to foreign investor surcharges. And we've got a very different rate of taxes that we apply to foreign investors, and for whatever reasons, some of them are particularly justified. But what we didn't think about, or maybe the policymakers did think about it and knew that there would be some pain down the track, was when we introduced much higher surcharges, stamp duty and also land tax. And what that did for some areas that were very foreign investment centric. Of course, if you take out a major proportion or a significant number of potential buyers of an area, you'll see value losses. And we saw parts of Melbourne that were particularly heavily impacted by Chinese foreign investment for quite a while. We saw those areas come off, and that would have really hurt the local property holders at the time to turn around and say that you've got far less equity than what you thought, or worse still, for those that had newly purchased and had negative equity. So there is always a consequence. Sometimes they're unintended, sometimes they're understood, and governments make tough decisions and grit their teeth and hope that we can push through the pain. But that was definitely something that I remember about 10 years ago.
And one thing that we saw as a direct result of that is it actually was deflationary to new home building, because a disproportionate amount of, especially Chinese investors, they covet the new properties. So they were actually stimulating home building. And I suppose as another example, if you think about international migration, of course, we had a very, very low unemployment rate. We had people crying out for baristas or, hospitality and retail workers. And of course, we bring these people in at I think, record numbers. But the data shows that typically these people for the first 5 years will rent. We were already at a time where we had quite a tight rental market, and that exacerbated that problem quite significantly. So, yeah, it's something that I think everyone needs to think about, and especially politicians. You move the needle somewhere, there is going to be a ripple somewhere else, and I suppose that's the focus of today. So thank you very much for unpacking this topic with me today, Cate, and we look forward to seeing Dave and yourself next week.
Yeah, it was great to catch up with you, and I enjoyed preparing for this one. I hope our listeners enjoyed it.
I hope so as well. See you next week.
See you, Mike.